Hello and welcome to our channel. Please note that the views expressed in this video is only for educational purposes. Today, we are going to look at the most common mistakes done by investors when applying for an IPO. India's primary market has been busy continuously with several companies making their way to IPOs. However, a large number of first-time investors are jumping onto this IPO frenzy in order to make quick money. In doing so, investors fall prey to misleading information which affects the investment decisions. Here, in this video, we are going to decode some of the common mistakes that investors do which one should avoid in order to make sound investment decisions. These are just broad guidelines and there are no right or wrong ways of investment. Warren Buffett's words are true for the stock market in general, and since the primary market is also a part of it, this maxim, that the stock market is a device for transferring money from the impatient to the patient, is apt for IPOs too. However, investors, especially new ones, find themselves at the receiving end, knowingly or unknowingly falling prey to these common IPO mistakes. Large numbers of IPOs have been floated and more to come. Not all IPOs are bad, so getting an allotment has become a tremendous task for investors. So let us share our learning, avoiding IPO mistakes done while applying, and we will also burst some IPO myths during the course of this video. Here are some hard facts that one needs to look out when investing in IPOs. For an investor, IPO makes no sense. It is an event for the company, venture capitalists and promoters. The investment banks are appointed to keep and justify IPOs at the maximum price possible. IPO company pays investment bank fees, so their responsibility is towards the company and not to investors. No promoter will like to dilute his share on discount. Investors' greed is exploited in IPOs. The important thing to remember is, values are found in bear market and IPOs are a product of bull markets. Here are the top 10 gainers for this year. In terms of listing gains, Sigachi Industries gave 270% returns against the issue price. The top gainer in terms of overall profit is Paras Defense, clocking a whopping 334% gains. Here is a list of the top 10 IPO losers giving the least gains and the least profits since listing. The least listing gains were delivered by Paytm, which was the largest IPO till date. The maximum loss was given by Suryodaya Small Finance Bank, shaving 51% from the issue price. Here is a list of IPOs which are ongoing as well as upcoming in December, and there are many more in the pipeline. In reality, there are no IPO tricks to get maximum allotment. The entire process is airtight and auditable. The only thing in your hand is to apply IPO in name of your family members' demerits. The more the application, more chance that you have an allotment. It is like a lottery. More application increases selection probability. If you see your quota being oversubscribed, it is better to put one lot in the application. Because in this case, it doesn't matter how many lots you apply for. An allotment is given for one lot only. So save money from being in lock-in under ASBA. If you have filled your form with due diligence and bid wisely, you will certainly get the shares allotted, if the issue is not oversubscribed and doesn't go for the lottery for allotment. The initial public offering is a first-hand opportunity to grab the shares of a company when it goes public. The major reason for investing in IPO is to grab the early gains of a high-potential firm. The second is to get a big return with a long gestation period. The third one could be to buy cheap and earn big to be rich in less time. Whatever may the reason be, we all want that share to be allotted when we bid for the subscription. Point number 1. 1 DMAT 1 application. To be in the running of getting the share allotted, one must fill only one application for IPO. In case an investor tries to fill multiple applications with the same DMAT and PAN number, even in that scenario, the application is rejected in the first go itself. Point number 2. An individual cannot apply in both the retail and the NI category in an IPO. He has to apply in any of the one categories. Individuals with application amount less than 2 lakh rupees fall in the retail category. There is a reserved allocation of 35% for retail investors. Some companies also give a price discount to investors in the retail category. In case of oversubscription, the allotment to each investor cannot be less than one lot. Resident Indians, HUF, NRIs, corporate bodies who apply more than 2 lakh rupees need to apply in the NI category. The reserved allocation is 15% for NI investors. But, in the case of oversubscription, NIIs get allocation on a proportionate basis. Point number 3. You can apply through any of your bank accounts, but it is advised to use the bank account linked to your demat because of the ease of transactions and liquidation. Point number 4. An applicant can use an existing UPI ID, which is linked to his or her bank account. One can also use the UPI-enabled app of the bank where one has an account, to create an UPI ID. Do not use the UPI ID of the third person. Many banks do not allow this. Currently, rules say any UPI will do, but many banks do not allow third-party payments for IPO. Point number 5. Every company issues the IPO with a price band and sometimes a fixed price. One has to make sure that the bidding price must lie within the range of the bid or higher than the range. In the case of a fixed price, the rule stays the same, the price or higher than the price. If your bid is lower than the price range or the fixed price, the bid will then be considered invalid. The investors bidding lower are filtered out and you stand no chance of getting shares allotted. Let's say, an XYZ company comes with a public issue of price range between 1,000 rupees to 1,100 rupees, an investor has bid for 1,010 rupees. After receiving the application and looking after the bids, the company closes the price at 1,080 rupees, so anyone bidding below 1,080 rupees will not be allotted shares. So, bid wisely at the cutoff price to be in the race for allotment. Point number 6. The most basic mistake is filling in the wrong or erroneous details. If you fill the details with incorrect demat account number, bank account number, UPI ID or incorrect PAN number, you certainly lose your chances of getting shares allotted. Mismatch of name on PAN with demat is one most common mistake that negates your chances of getting shares allotted. So, before you file your application, double-check your bid for such mistakes and correct them, in case you have any. Point number 7. Paying too much attention to gray market. Gray market may be a valuable tool to gauge interest levels and potential listing prices, but let us not forget that it is eventually an informal mechanism. It works effectively when markets are stable but has tendency to become unpredictable and unreliable when secondary markets witness increased volatility. Like other things unstable, gray market is open to manipulation and has let down the investors in the past. Dealers and brokers buying applications have failed to honor their commitment on a number of occasions. Basing your investment decisions solely on gray market premium is not a wise strategy, and yet, the number of people checking gray market rates every day is mind-boggling. This makes it the top entry in the list of most common IPO mistakes. Point number 8. Following the herd. Just because everyone among your friends is gung-ho about this new IPO, should not be a reason for you to follow suit, especially if the company operates in a market or segment you don't understand. In bull markets, almost all IPOs are oversubscribed, but not all offers give positive returns. It is important to understand the dynamics of the company and study their working model and long-term growth prospects before investing. Point number 9. Falling prey to fads, mania, or bubbles. Another entry in our list of common IPO mistakes. Many times, investors don't realize that what they are playing isn't a theme but just a fad. Similarly, markets sometimes go euphoric and prompt investors to lose their senses. Any investment made at this time is likely to turn into a disaster, as most likely, valuations and projections are sky high. As a result, investors would have to go through the financial books of the companies and invest only if convinced on its valuations. Point number 10. Basing the decision on subscription data. Another trap exists in the form of subscription data, and investors can be often seen putting a greater attention to subscription data than the fundamentals of the company in question. Let's not forget, subscription is prone to manipulation and is often a manifestation of investors' herd mentality. Remember, Reliance Power IPO, one of the biggest IPOs in India, was fully subscribed within minutes of launch and still holds the record of earning maximum subscription amount. Everyone knows how that unfolded for investors. Similarly, caution is warranted in the case of interest from high net worth individual HNI investors. HNIs are key players in grey market and often go for leveraged IPO applications. What this means is that there is added interest cost for HNIs for every additional day they hold the shares. As a result, they tend to sell on the listing day and the selling pressure increases in the event of poor listing. Retail investors unknowingly make themselves vulnerable to listing day volatility by tracking and paying too much attention to HNI subscription. Point number 11. Neglecting your comfort zone. Every investor who has spent 5 years in the markets in a productive way tends to develop an investment philosophy, knowingly or unknowingly. This means that one develops a certain understanding and level of comfort with some industries. While this learning may be very loose and intangible, it defines one's area of comfort and to an extent, competence as well, and often helps in avoiding IPO mistakes. Venturing out of this zone could be problematic for investors if the markets decide to take a dip. A towering example is Warren Buffett, who stayed away from technology stocks and IPOs in 90s as he didn't see a moat, a long-term competitive advantage, in technology companies. Even the Oracle admits he doesn't understand every business model. Point number 12. Overestimating your staying capacity. Another important barometer is an individual's staying capacity, and this needs to be seen in conjunction with the above point regarding comfort zone. This is very much a behavioral aspect of the investing process, and it is not uncommon to see even well-informed investors selling at lower rates as a result of panic selling. Buffett's lead is again very helpful here, and he advocates investing into businesses which are going to be around in prosperous conditions even if the stock market shuts down for 10 years. This is not just one of the several IPO mistakes but a much bigger issue of wrong asset allocation. Investors often overestimate their staying capacity in the market or specific stocks as they go overboard by investing all the surplus funds in stock markets. When markets go down, investors fail to take advantage of lower prices as there is no surplus cash left with them, and also struggle to keep up with other commitments. More often than not, equity investments are the first ones to be liquidated when requirement of funds arises. Lastly, going for big applications. SEBI has changed the way IPO allotment is done, and now, all the retail applications, smaller than 2 lakh rupees, are treated equally, irrespective of their size. As long as the retail portion is getting oversubscribed, the chances of getting allotment are equal at both ends of the spectrum. By making big applications, investors essentially block a larger amount while the probability of allotment remains same. In fact, this is one of the most common IPO mistakes investors continue to make. To sum it up, avoiding these mistakes are not very difficult. However, one needs to exercise caution in understanding the story behind the IPO, evaluate and then apply investing decisions. Participants only look for listing gains and do trading, which is not a protocol for investing. Hope you liked the video and the information was useful to you. Kindly like the video and subscribe to our channel for more of such videos. Thanks for watching. Until next time, stay safe, stay healthy, and have a wonderful day.